Hey guys, welcome back to High Yield Intraday Trading. I hope every one of you is doing good. So before we start discussing today's topic, let me request you all to subscribe to my YouTube channel by clicking on the subscribe button here. Once you click on it, you will get the confirmation on the left bottom corner. Post you subscribe to my channel, also make sure to press the bell icon and click on all. You will get the confirmation on the left bottom corner so that whenever I upload a video, you get the notification about the same without any misses. Also, I would request you all to subscribe to my Telegram channel with the name HYIT Intraday Calls because I share a lot of things over there and it might be helpful to you in some way or the other. All right, so before we start with today's discussion, please allow me to mention about an offer that will reduce your capital requirements for trading various segments like the NSE futures and the MCX futures. Okay, talking about the NSE futures, you can trade contracts like Nifty, Bank Nifty, SGX Nifty, etc. with just 6,000 rupees for one lot, whereas in MCX you can trade one lot of crude oil, copper, natural gas, etc. for just 4,000 to 6,000 rupees. Okay, for gold and silver, it will cost you around 10,000 rupees per lot. And not only this, you will be happily surprised when you get to know the other features that are being offered. I can't give you all the details here as there are many, but I will surely share all the details post you get in touch with me. In today's scenario, if you want to trade one lot of crude oil, you need to have a minimum of 1.6 lakhs as your capital, that is 1 lakh 60,000. Similarly, for Nifty, for just one lot, you need to have at least 1 lakh as your capital. Now replace 1.6 lakhs with 4,000 to 6,000 rupees and 1 lakh with 6,000 rupees. It does make a lot of difference to a retail trader like you and me, right? So that's the help I want to extend or offer. And if you are interested, then you can get in touch with me on the details that are being shown on the screen and we can take it forward. All right. So as I always say, if you are someone who trades the Indian stock markets, then you just cannot depend on price action and trade. Chances are that you might get stuck in the trade, or also there are high chances that you might end up in a loss. So the baseline that I want to set here is that do make use of indicators and oscillators to take your trading decisions because they won't harm you anyways. I mean, you can avoid using oscillators, but you are not if you are not comfortable with them, but make sure to use at least some indicator that works well as a support or as a resistance. Okay, and the things that you might hear stating that indicators are lagging and that's why you cannot trade using them and all those similar stuffs, please don't believe those stuffs because it's not true. Okay, the fact is you need to know how to use a particular thing, and people are not ready nowadays to invest their valuable time in knowing how to make a thing work. Hence, that doesn't work. As simple as that. Okay, and also please be mindful that I am not simply suggesting you to use the indicators. I'm suggesting you to use them because they do work in the live market, and I keep proving it every now and then through the calls that I give in my premium Telegram channel or also in the public Telegram channel. Okay, and if you see the calls that I give to the premium members in the screenshots that I post on my website, how many times do you see that the stop loss is getting hit? It is very rare, right? Right? I mean, we hardly hit a stop loss once in 2 to 3 weeks, or maybe in a month. It might be in Nifty, or it might be in Bank Nifty, or it might be in crude oil trading as well. The stop loss hits are very rare. So from here, you can very well imagine how strong the technicals are. So that proves 100% that indicators do work and they really work well only if you know how to use them. Okay, so having that said, in this video, I will take an example of a scenario wherein you would see that there was a breakout happening as per the price action, but that breakout actually did not sustain itself and later the prices fell. But if at all you would have used an indicator, the things might have been different. You would have got a lot of more opportunities to trade that particular stock or index. Okay, you would be having a completely different perspective to trade that particular stock or index rather than waiting for the breakout to be happening and later getting betrayed by that very breakout. Okay, so let's get on to the charts and let me explain the stuffs there so that things become more clearer. Okay, right. So this is a best case scenario which I have already taken to save some time. Okay, so as you can see, this is the Nifty's futures chart. Okay, and the time frame that I'm following is 5 minutes, as you can see on the left top corner. Right now, we are talking about intraday trading. That is why I'm explaining the stuffs in a 5 minutes time frame. Okay, so please remember that all the perspectives that I will be giving in this video is in relates to the intraday trading and not swing trading or positional trading. Hence, we are following a 5 minutes time frame. The same can be followed in a 15 minutes time frame or a max in a 30 minutes time frame maybe. Okay, so what you see here, the day started, and where exactly do you see a consolidation happening? A good amount of consolidation. Where do you see that? Well, I would say this is the place, right? This very place is the place where the consolidation was happening, right? And the consolidation was happening from around 1:30 in the afternoon till 2:30 in the afternoon. It was almost 55 minutes to a 1 hour time wherein the Nifty was consolidating. Right? So after consolidation, what is the expectation? The expectation is either it will go up or it will come down. Now, in this scenario, what happened actually was the breakout happened in the upward direction. This candle you see there, the 2:30 p.m. candle, right? This one, this was the candle which actually breached the consolidation zone and closed above it. Right? Let me take off the pink lines so that things are more clearer. Right? So as you can see here, let me make it a bit bigger. Yeah, so as you can see here, this very candle, the 2:30 p.m. candle, was the candle which actually breached the consolidation zone and closed above it, right? And the very next candle after that, that is the 2:45 candle, it also was a green candle. Now these two candles together give a feeling that okay, the stock has fallen much and it consolidated after the fall, right? And after the consolidation, now Nifty is ready to go up. That is what the normal thought process would be, right? If you are following a price action thing, right? So let me also put in some other points. Now, why would you think that Nifty would be going up after this particular candle, after this 2:30 p.m. candle? Why do you think that Nifty might go up? Well, if I think like a trader who is quite new to trading, these are few of the points that I might consider. Number one is, of course, this particular consolidation zone has been breached by the 2:30 p.m. candle. That is point number one. Point number two is Nifty has been falling continuously since the starting of the day, right? Falling, retracing, falling, retracing, falling, retracing, falling, right? So this is the scenario since the morning. So as a trader, I might think that how much more will it fall, man? Right? So it has been falling since the starting of the day. Now, since it has consolidated and now it has since that it has given a breakout in the upward direction, Nifty is ready to go up from here. That is point number two. Why you might think that Nifty will go up further, right? After this breakout. Point number three is this gap has been filled, right? This is a gap, right? Right from here to here, it was a gap up opening that Nifty gave, and post the gap up opening, it moved up a bit, and then it was falling continuously for the entire day. So, and in the process of falling, it actually closed this particular gap here, right? So the gap was closed. So normally the thought process about gaps is, if the gap is closed, then that particular stock or index should go up, because that gap fulfillment should work as a support, right? That is the normal theoretical part that we always hear. So these are the 3 points, or I would say these are the few points that a particular trader might think and conclude, just a moment, yeah, and conclude that Nifty will go up after this particular breakout, right? But what happened in real time? Nifty went up for a while, right? Nifty went up for a while, faced a resistance here, and again it fell. So this was a fake breakout. Now, if you are a price action trader, and please be mindful that I'm not making any offense to the price action traders. I'm just putting in a scenario where we see that it was a fake breakout. Okay, so no offense to the price action traders. If you call yourself as a price action trader, well and good, it's good for you. The thing is, you should be in green and you should be earning money from the market. That's the whole point, right? So back to the topic. So as you can see here, it was a fake breakout and Nifty continued to fall further. Now, let me bring in an indicator. Okay, let me delete these lines and let me bring in the exponential moving average. And the exponential moving average that we will be using here is the 80 EMA. Okay, so this is the exponential moving average. Okay, now if you would have used this particular EMA, the 80 EMA, things would have been more clearer. Don't you think so? Because when this particular breakout happened here, right? Obviously, you will not take up a trade at the ending of this or at the closure of this candle, right? You have to always wait for another candle to see if it is actually a good breakout or not, right? So the next candle was also a green candle. So if you are a price action trader, you would have actually initiated a buy trade after the closure of this candle, the 2:45 p.m. candle, right? Now, if you would have used this 80 EMA earlier, you would have clearly seen that this 80 EMA might work as a resistance and will not allow Nifty to go up further. So you would have avoided taking a buy trade at this point, right? If at all you would have used this particular indicator. Rather, what you would have done is, when you see that the breakout has happened here as a price action trader, you see that a breakout has happened here and the next candle is also a green candle, and there is a resistance sitting right above this green candle, you would have never dared to initiate a buy position. What you would have rather done is, you would have waited to see if the 80 EMA is working as a resistance or not. If it is working as a resistance, then you would have rather shorted Nifty. You would have initiated a sell position and not a buy position, right? So if you would have been someone who would have used the 80 EMA, you would have actually initiated a sell position at this point, okay, after the closure of this red candle, because this red candle clearly tells you that Nifty is facing a resistance because of this 80 EMA. Hence, this gave a red candle, and also according to the price action, since we have a decent wick on the top of this particular candle, right? It also suggests that the bears are not ready to settle at a higher price. Hence, we got a red candle, right? So you would have waited for this particular red candle to close, and your sell entry would have been any price below this particular line. That is the closure of this red candle. You would have shorted Nifty if at all you would have used an indicator. You getting my point, right? So indicator, according to me, gives a very good clarity, right? It defines many things. The only thing is you need to know when and where to use a particular indicator. In this case, we are using an exponential moving average. Okay, 80 EMA is just an example. If you're comfortable with 20 EMA, which is very famous, or if you are comfortable with 50 EMA, which is again very famous, you can use those as well. But the thing which I want to state here is you need to know how to use that particular indicator. It might be an EMA, it might be a pivot, as I told in my previous video. It might be Bollinger Bands, anything, any technical, any indicator. You need to know how to use it, and then you will surely see the results, how it earns money for you. Okay, now if we talk about some more scenarios here, okay, if we go back on that particular day, where do you see the other consolidations to be happening? I would say this was a consolidation, right? This area was a very nice consolidation. So where would you initiate a sell trade here? The consolidation was broken at this point, right? Let me delete things here. Okay, so this consolidation, just a moment, this area's consolidation, right, was actually breached when this candle's low was broken, right? This red candle's low. So you would have again initiated a sell trade here very easily. You would have initiated a sell trade here because the price action is supporting a down move, because after consolidation the low of this candle was breached. So that is point number one, that is the first confirmation. And also the indicator that you are using, the EMA, is also telling that the price is bearish. So you're having two confirmations here. So easily you would have initiated a sell position after the closure of this red candle, and you see the results here. You would have gained this very easily, right? This is one scenario. Another scenario is what I can see here is this this candle, right? So it fell, right, and again it went up to make a higher low, right? So this was the low high, low low, low high, low low, low high, lower low, low high, lower low, and this is the lower high. So after this fall, it went up again to make a lower high, and it fell again. So if we just follow price action, this candle that you see here, that is a kind of a doji, which is which tells us absolutely very clearly that the bears are trying to push the prices further, that they are not ready to settle at such a higher price. That is why we have got this big wick on the top of the candlestick, right? So this becomes a kind of a bearish pin bar, right? So you get a bearish pin bar here, you follow the price action, that is fine. I'm sorry about this. You get a price action, that is fine. And second confirmation is your EMA, right? So this EMA is also bearish. I mean, it is telling that the stock prices are bearish because the stock prices are just below the EMA. So it is very clear that this particular 80 EMA is working as a resistance and will make all the efforts to make sure that the stocks go down further, that the stock price, I'm sorry, goes down further. And the same happened here. Okay, so this were some of the things that I want to explain on the charts, guys. Okay, so just a moment. Let me see if I'm missing on anything. Just a moment. No, I'm quite okay. I've covered quite a lot. Okay, so this is what I wanted to show you guys. And again, let me repeat it. There is a huge difference, okay, between explaining the price action. Just a moment. I'm sorry about this. Let me minimize this and get back to the presentation. Right. So what I was saying was there is a huge difference between explaining the price action on the charts when the prices are static and when you trade the price action when the prices are moving. Okay. So please make sure that you should get biased in the right direction and not in the wrong ones, because when you trade live, most of the time you won't see the prices moving in your anticipated direction. Okay, so to have that in control, I would suggest you to make use of the indicators, because they give a very clear, or I would say they draw a very clear boundary wherein it defines the time till which you can stay back in the trade, or the time when you should actually come out of the trade even before the stop loss is hit, and stuff like that. Okay, so take your decisions wisely, which should be supported by a very strong logic, and then you should be good to go. Okay, so that's it from my end, guys. And for the guys who have not watched my previous video, I have put in the video card on the top right corner of the video, the I symbol that you see there. You can click on it and watch my previous video. And as always, we request you all to like and subscribe to my YouTube channel. And also, please do not miss the ending of this video, as you will get some more information about HYIT that might be helpful to you in some way or the other. And please feel free to ask your questions or queries, if any, in the comment section, and I will surely reply back to them. And also, please do not forget to like this video if you liked it. Okay, so that's all from my end, and I will see you all later. Hope you all will stick back. Happy trading and take care of yourselves. Bye bye.